and welcome to the annual outlook as presented by Centrum for 2026. The year gone by has been a very interesting year. It has been a proverbial roller coaster ride, if you may say so, in all the spheres of the Indian markets as you would know it. The major shift that we noticed in the Indian markets was that from 2020 onwards till about 2024, the Indian markets were primarily driven by government capex, but this year we made that pivot from a capex-driven economy to more of a consumption-driven economy, and we saw two very concerted efforts being made on that front. There was an indirect push to increase the disposable incomes of the consumer through the tax slab cuts, and then the rate cuts from RBI, which was not enough to push consumption. Then we had a momentous decision. For the first time ever, we had the GST rate rationalization, and that has really helped in picking up the overall earnings growth of the economy. We've seen about mid-single digits of an earnings growth in Q1 and Q2, marginal cuts also coming through, but for the first time in Q3, our sense over here today is that for the first time people are expecting about 9% sort of earnings growth coming through from Q3, and there might be a very, very realistic possibility of a positive earnings surprise coming through from there. So that's one of the bigger factors where the positivity in terms of outlook for the equity markets comes through. And more importantly, the domestic economy has defied all logical norms and continued to stay as strong as it is despite every single bit of the global geopolitical pressure that it has faced. We've seen on an average about 8% GDP growth rate in real terms in the first half, and that has been a very, very big surprise for the market in itself. RBI has cut the rates by almost close to 125 basis points, which has been very, very helpful. But I think given the way we are pivoting and given the way the economy has been moving, I think we are almost towards the fag end of that rate cut cycle now. I think for the next few months, if my guess is right and if our guess is right, we are in a phase of stabilization. The only real concern from a macroeconomic perspective which we need to watch out for is going to be a currency, where we have already seen the rupee dollar go to 90.91. And that is going to put pressure on the balance of payment and the current account deficit. Because of de-dollarization, the gold prices have also been moving up. So that's been kind of a double whammy. And this is where, Ritwik, I wanted to get you into the picture. That, for the last 2, maybe 3 years now, we've been seeing one geopolitical event after the other at the global scale level. And the expectation has been that this is kind of now coming to an end. And every time it kind of starts easing out, there's something new that tends to happen. The latest flashpoint we all know. In that context, specifically more so from a rupee dollar perspective, the currency, global currency perspective and the interest rates, how do you think it would impact the global markets?
Yeah, thank you, Manish. I think let's first identify the 4 or 5 crucial factors that are there in the global markets right now. I think the first bit is the geopolitical risk, which is the risk premium there is going higher. Whether you look at Russia, Ukraine, whether you look at the Middle East conflict, whether you look at Latin America, and now with the new zones of uncertainty, as I call it, Greenland, and even Latin America, Colombia and all these areas where US hegemony is playing its part. That's the first bit. The second bit is obviously the US easing rates. Now there's no tight monetary control, there's easing there. The third one, which is most important, is Japan has sort of switched gears and they are looking at a high inflationary kind of a market, which has resulted in the yen unwinding of carry trades in the yen, which has created cross asset volatility. And if you look at the commodities plays globally, gold has become the stable reserve, sort of an alternate currency. All central banks are upping their gold reserves. India itself has about $100 billion plus of gold reserves. And if you look at it in terms of silver, for the first time, you see a duality in silver, not only in terms of the investment upside, but also in terms of the industrial usage. And not only silver, I should say copper as well, has seen a tremendous upside where there is a direct correlation with the electrical fields, the EV business, and anything to do with infrastructure. So I see overall markets in terms of real GDP growth for India has been great. It's been around 6.2%. If you look at markets across, whether it's China, which is in a deflationary kind of a scenario, you look at Japan, it's about 2.1%. If you look at US, it's also around that 2.1%. So India is poised for it, but we have to look at the geopolitical side of things. And I think if I want to really understand it, and if we want to really understand it more, let me switch it over to Umang and generally understand what are the plays on fixed income and equities, and how does it play into the model portfolios that we recommend and for our clients domestically. So over to you, Umang.
Thank you. As far as the fixed income markets in India are concerned, I think the point that Manish mentioned, that we seem to be towards the fag end of the rate cycle. The monetary policy has been upfronted with a lot of rate cuts being front loaded. I think that was expected to play out on the yields. However, in spite of the rate cuts and RBI providing enough durable liquidity, I think the yields have hardened on the longer end of the curve. The shorter end actually played out well, but the longer end, the yields have in fact hardened in spite of the rate cuts. So what we believe is that still the middle or the medium to short end of the yield curve actually offer very good value. That is one part on the GSEC strategy. As far as the corporate bonds are concerned, I think the spreads between AAA and GSECs have come close to their long-term averages, whereas the AA and A corporate bonds, A-rated corporate bonds still offer very meaningful spreads, and I think that will also widen as time goes by. So people with about 2 to 3 years horizon will do well to be part of the short to medium duration curve, as well as park some money in terms in the corporate bonds as well. Yeah. That said, I think Abul can highlight what is happening in the equity markets purely from the point of view of the sectors and some of the key segments in the market, like large, mid, small. Yeah. What do you like, and where exactly do you think we are?
Yeah, thank you, Umang. So if I take the key points that you guys have discussed, I would more generally talk about equities in general, which are largely driven by the corporate earnings over a longer term. In the short term, all those factors that we discussed, geopolitics and other uncertainties, keep the prices under check. But over the longer run, that's the corporate earnings is the only thing that drives the market. And if you look at the performance of the market over the last 15, 16 months, it's largely the earnings downgrade that had happened. Q2 results were the first one where the downgrades have not happened, and it's a very good chance that you may see some upgrades going forward. Consensus is forecasting FY 27-28 CAGR 2 years to be closer to 15%, and we believe that CY 26 should be a good year for equities, but it will be very, very stock pickers market, bottom up approach. All the asset managers who do bottom up stock picking should start doing well. Bias towards the large, small and mid cap. If you look at, this is the longest stretch of underperformance by the small caps versus Nifty that we have seen over the last 22 years. And within a small cap, we can't just play blindly the index. It's a very, very selective thing, like top 25% performers and the bottom 25, the difference is huge in the small cap index, like unlike other indices. And among the sectors which I prefer at this point in time would be banking and financial services, healthcare, metals, apparel retail, and IT could be a dark horse. So IT, because despite the earnings growth being sluggish and the outlook not that great, the sector has underperformed, and purely from a sector rotation strategy could be a sector to play.
Valuation play.
Valuation play, purely a valuation play. What do you, Manish?
So in that context, we've kind of seen what the global geopolitical viewpoint is. We've seen the view on currency and the rates. We've kind of covered a little bit of fixed income and a little bit of equities over here. Umang, just to wrap it up and give it a logical conclusion, what should be the portfolio strategy from an investor point at this point in time?
Right. I think the portfolio strategy should hover about optimism, which is basically being constructive on equities, and within the fixed income markets, we suggest that approach a barbell approach, where you stack up on the short end of the yield curve or the medium end of the yield curve, and on the other end look at yield maximizing through private credit funds or credit strategies, which basically are run by seasoned managers and they have seen across the cycle performances. As far as portfolios are concerned, I kind of agree with Abul that this year is going to be a year of stock pickers. This year is also going to be focusing on managers who are very conscious of valuations. So bottom-up stock selection and valuation consciousness is going to be the theme as far as equity portfolios are concerned. On the balance, we believe that after this 16-18 months of time correction which the markets have seen, I think the year should give meaningful entry points to long-term discerning investors.
So there you have it. We've had a very enriching discussion over the last few minutes, and to just conclude it in 3 or 4 broader points, I think what we are basically saying over here is that from a global geopoint perspective, do not expect any stability at any given point of time anytime soon. The global macro is going to continue to be full of surprises. We've seen that in Japan, we've seen that in US, we've seen that in across the board. But at the same time, as far as fixed income is concerned, the strategy seems to be very clear. It has to be a mix of private credit, corporate papers, as well as the shorter end to medium end of the duration is what we are talking about over here. And then as far as equities is concerned, clearly the time to go a little more overweight on equities than we have been in the last 15 odd months. More constructive on the small and mid caps, primarily because of the underperformance. But again, at the same time, more value conscious, so find a bottom up approach to stock picking where you are able to balance growth and valuation both. But clearly, the message I'm getting from everybody at this point in time is that the time to invest is now. Happy investing.